So I would like to also welcome on stage the next panel, the asset management. I would like to remind you again, please join Slido so we can have some questions at the end. And with that, yeah, we're going into the next session, which is also a very interesting one. Again, we would like to see the Treasury as a strategic partner, and I think asset management and how to get better returns is a valuable part of that. Andritsopoulos will moderate the panel, and please introduce.
Good afternoon, everyone. It's a pleasure to welcome you in today's panel, Asset Management, a Journey Between Risk, Return and Sustainability. I'm Konstantinos Andritsopoulos, Head of Treasury at Volton Hellenic Energy Group, and I'm going to be your moderator today. I'm going to start by formally introduce our esteemed panelists. We have Mrs. Sandrine Rougeron, Global Head of Corporate Clients and Corporate Pension Funds, as well as Head of Liquidity Solution Sales at Amundi.
Hello.
Next, we are honored to have Mrs. Nefeli Bernitsa, and distinguished partner at Bernitsa law firm.
Thank you very much.
And finally, we welcome Mr. Daniele Curci, Head of Investment Specialist and Business Development for Liquidity Solution at Amundi.
Hello.
We're fortunate to have such diverse and accomplished group of expertise here today. Before we get started, I would like to mention a few things about the subject and why we selected. Because in a rapidly evolving financial landscape, asset management is no longer based about balancing risk and return. A third dimension has came called sustainability. It's a vital third dimension in decision making, so it's reshaping how portfolios are structured and managed. Today's discussion will dive into that subject about the complex of balancing act, and to understand how corporate treasurers and asset managers are adapting to new risks, emerging opportunities for return, and integrating sustainable practices to meet both regulatory frame as long as ethical investment. So, to begin our discussion, I would like to direct our first question, and how has increasing emphasis on sustainability and ESG factors reshaped the landscape of investment management? And what are the most significant trends driving this integration into portfolio management, influencing corporate treasurers and investors' behavior? Sandrine.
Thank you, Konstantinos. So it's a long question, deserving a short answer. So we've got a few minutes. Happy to be with you today, and thanks for Hellenic Association of Treasurers to give us this opportunity to exchange with you. So globally speaking, what are the trends we see that we've seen? Responsible investing is nothing new, in particular for us, an asset manager company, since it was a funding pillar. It's one of the funding pillars of the company I'm representing. Now, in terms of trends, we see 2 or 3 major trends. The first one would be the fact that the industry is maturing when it comes to this subject. I'm not saying that it is stopping. On the contrary, it has reached a maturing level, making necessary now to go for a more granular approach. We've had big debates, big ideas, big words, necessary, urgent. But now, all the actors need to go for a more granular approach. When I say a granular approach, I mean some more specific measures and actions. How do we see it today? First of all, we see that this industry is maturing via the fact that we see more resilience of flows towards the most selective ESG strategies in Europe. So this is key, and it demonstrates that the industry is maturing. Investors are focusing and looking for definitely more ESG strategic investments. Second thing, that facts as well, investors prioritize not only, of course, financial returns, because it's key, but also measurable environmental and social impacts. Last but not least, RI, responsible investing funds, prove to be more resilient over the last years, and especially last year, than non-responsible investment funds. So all these showcase for, of course, an industry maturing with investors looking for more materiality. This is a major trend, maturing industries. The second major trend is we are living in a more complex world. Many concepts, many words. You've had other panelists before explaining to you the different words, necessity of labeling or not, etc. So we are living in a more complex world with many people, many countries, many initiatives being taken everywhere. So you as an investor, of course, you need to find your path, which is not that easy. So at the end of the day, we need to take into account that despite all these debates everywhere, trying to find one only way of thinking, we need to keep in mind that we've got a wide range of purposes. We've got a large variety of implementation of methodologies. There is not only one solution. And of course, diverse degrees of intensity to approach it. And I will keep it short, sorry, I'm a bit long, but last but not least, of course, now we need to make actions. The word 67% of asset owners are convinced of the materiality of ESG factors. So it shows case that now industry is maturing. It's set, it's complex, but we need to have different way of thinking. But at the end of the day, we are all convinced that we need to move forward and that ESG factors, sustainable investing is key.
Thank you. Maria Nefeli?
Thank you very much, and thank you for the invitation to speak here. I would like to challenge the premise of the question a little bit. And I would like to question whether the asset management industry has really been reshaped in the context of ESG. Because what we're seeing two opposing forces. One of the forces has been beautifully illustrated and described by Sandrine, and I understand it's also what Amundi does. The other, and that is a push towards incorporating sustainability. The other force we're seeing is the need to achieve those returns, achieve those financial returns in a broader environment that is quite volatile, is currently subject to geopolitical crises, uncertainties with the US elections, and higher interest rates, which have steered certain amounts of capital towards different directions. So we see a lot of the funds actually questioning the dedication to ESG when they're under a lot of pressure to get to those financial returns.
Thank you. And I want to build on that, having you in the panel, and to switch our discussion towards more to regulatory landscape. So my next question will be, how do regulatory frameworks, both domestic and shape the incorporation of sustainability factors into asset management? And what challenges do companies face in navigating these legal obligations?
Before we put everybody to sleep, I won't keep it too technical, but I think your question goes to the core of the never-ending debate between regulation and market. Should law and regulation pave the way for the industry and be ahead, or should law and regulation come and kind of polish or organize the way the industry is working? And in Greece's case, the primary driver behind regulation is EU legislation. EU legislation is the front runner in ESG legislation globally. And what we see is we often see a lot of time inevitably having to go through between inception of the law and actual implementation in member states. So you have the various deliberations, debates, compromises, agreements, translations, and then all of this, like in the case of the CSRD directive, all of this then needs to be actually implemented by each member state. And in that case, by the time it is implemented, we see that the industry has moved ahead and the industry becomes a bit confused as to how this new legislation fits in the way it has been working to date. There are certain instances, like the taxonomy, which was mentioned in the previous panel, where the law is actually a lot more complicated and a lot more granular than the industry has become. And in those cases, the implementation of those laws is actually a huge shock to the industry. We also have certain pieces of legislation, such as SFDR, if I may say, where parts of it challenge the industry to change what it's doing, and parts of it are a bit behind where the industry is in terms of compliance with certain parts. So we've already talked about taxonomy, SFDR, and NFRD changes which have already applied, and we're looking ahead at CSRD and CSDD. In applying these, we see three key challenges for Greek asset managers, which are also consistent with asset managers outside of Greece. The first one is the debate between the investor relations team and the rest of the and the rest of the asset manager. And I was actually seconded when I was in London. I was seconded to an asset manager to implement their SFDR project, and it was a fantastic debate. I was mentioning it earlier. It was a fantastic debate where investor relations were saying, "But our fund is green. I don't understand what you're talking about." And then we were saying, "Well, under SFDR." It isn't quite as green as we think it is. And in striking this right balance between these two teams within an asset manager, there needs to be more clarity on the law. The second challenge is the huge cost and time investment in actually applying and conforming with these laws. And the third challenge, which was also mentioned in the previous, in one of the questions actually, I think, and I'm not sure it was fully addressed, is the lack of meaningful data from SMEs. There's scarce low quality data, lack of standardized reporting, and difficulties in tracking and verifying that data.
Thank you, Maria Nefeli. That was very insightful. Daniele, I'm coming to you and the ESG subject. So our next question. How does the integration of ESG criteria impact portfolio management, particularly in terms of risk mitigation, financial return, and identification of material ESG factors?
Yeah, thank you for the question. Yes, of course. First of all, I want to mention that for Amundi, since its creation, the ESG is one of the most important pillars that we implemented in our policy of investment in a different strategy. We have an internal screening that is based on a proprietary framework. So the investment setup is composed by a number of different processes that allow us, for example, to have a best-in-class approach. So we have 38 different criteria, some generic, some more specific in line with the different sector of activity of our issuers, that allow us to create an internal score from A, the best, to G, the worst, where we used to withdraw for the investment universe of our money market fund, the G score issuers, and sometimes the F. It depends on the different strategy. The different pillar, the E, S, and G, are weighted in relation of different sector of activity. For example, for a money market fund where the part of investment in the financial sector is more important, we give more importance to the G, to the governance side, to avoid the potential future financial point for in our investment universe. Then we have exclusions that can be more generic, linked to the participation of international agreements, and some more specific thematic, like the exclusion we apply in the tobacco, in the coal, and the nuclear weapons sector. So we can't invest in this kind of sector. We also have the beat the benchmark process. It means that the average score in terms of ESG of our portfolio should be higher of the one of the benchmark you use it is more indicative for our investment universe after having withdrawn the 20% of the worst rated issuers to make the competition more difficult. But having said that, so there's lots of rules that we need to respect. There's no negative impact on the financial performance of our funds because applying an ESG screening, it means having more qualitative issuers in our investment universe. So it's sort to create a portfolio more secure than otherwise. And in particular, the challenge for us is to have more and more detailed data to create a more competitive investment universe for us.
And now, building on that, an important element in both traditional and ESG-focused portfolios is diversification.
Yeah.
So that leads us to the next question, and what role does diversification play in balancing sustainable returns and mitigating risk within asset management?
Yes, of course, diversification is very important for money market fund and is always granted because we need to respect a number of rules, European rules, MMFR regulation, for example, that impose our money market fund to avoid concentration on issuer level. So in general, we can't be exposed to more than 5% on a group issuer in our portfolio. Internally, in addition, we also prefer to diversify the maturity of each instrument so that we don't have any problem integrating ESG criteria versus diversification. As I already mentioned, the ESG criteria help us to avoid reputational and financial risk within our investment universe because well-noted ESG issuer will be less impacted by negative potential credit event in the future. So sometimes we can have some issuers that should be withdrawn from our investment universe, but the idea, our objective is not to have a less diversified portfolio, but will be more to replace this issuer with a new one in line with our criteria ESG we have in the portfolio. So our target is also to helping issuers to maintain this compliance with the ESG criteria, to maintain the possibility to be part of an investment universe. And just to underline the fact that when we assess the internal assessment of the ESG doesn't concern the single instrument, but more the issuers we can use for our strategies.
Thank you. Now we're going to focus in a specific area within asset management that is critical for many organizations and treasurers. That will be money market fund. And Sandrine, my question is how important is the significance of responsible investing for corporate treasurers when choosing money market funds?
I will thank you again for the question. Hope you can hear me well. Yes, it is significant. It is important. Not only for money market funds. We are here today since we're here to exchange with you regarding, of course, your immediate need in terms of liquidity investment during this conference. But of course, your investors, your issuers as well, as corporate treasurers. So I would like to tackle the two angles. As a large investment company, of course, we buy a lot of debt. We propose investment solution, but we are a large financer of the economy. And of course, we do have a regular discussion with you all the time. Daniele was just mentioning how we select the issuance, short term, but as well medium long term. You issue bonds on different maturities. What is it? How is it important to have this ESG sustainable investment approach as well embedded in our funds? So to make the story short, it is significant. Responsible actors, you are all responsible actors of the economy, as well as responsible issuers of debt, as corporate treasurers. And of course, when we've got a natural dialogue with all the issuers, with all the investors, with all the corporate treasurers, when it comes to invest in money market funds, yes, you take this into account as well. Nevertheless, of course, for such short-term instruments, let's be clear, first goal is security and liquidity. If we focus only on money market funds, to attend the questions. But of course, the fact that sustainability is at the core as well of our investment process, just as developed, yes, it's key, it's important as well for you. But we know well your needs, and of course, liquidity and security will always come first. Generally speaking, you do issue bonds as well. Of course, you're more and more sensitive to the fact that when issuing bonds as well, us as an investor, we take a closer look, and we've got a raising appetite, of course, to buy bonds showing case for a sustainable approach. Sorry for having been
And now
a bit
back
too long.
to the ESG and the reliance on ESG ratings and third-party data. Daniele, our next question is, how do ESG ratings and third-party data providers influence investment decisions, and what strategies can investors use to navigate inconsistencies in these ratings?
Yeah. Actually, we receive a lot of data from external providers that are selected by Amundi in relation to the different sector where they are specialized, like, for example, controversies, SDG, subbrains, or climate transition, for example. So these data that are received are elaborated internally by a very important team of ESG internal analysts. We have 70 people all around the world in our different subsidiaries, helping us to work with this data, and that will be used for the internal assessment and the creation of our internal score. And all this data on a global level and more detailed level will be sent directly to the investment tools that are used by portfolio manager, and will be very important for the decision that will be taken in the framework of the construction of a portfolio. In order to avoid the difficulties of clients to navigate inconsistency, 2 points should be underlined. The first thing is that all our money market funds are in line with the SFDR regulation article 8. And the second one is that the transparency is one of our most important priorities. And as a symbol of that, we decided to create a dedicated annex in all our monthly fact sheets of our funds, where we illustrate the positioning on an ESG side of all our metrics against the benchmark. And also we illustrate some KPI. So we are following, for example, the carbon footprint of our funds, as well as the gender diversity in the management of the company used to construct our portfolio.
Having that conversation, I cannot not mention the term greenwashing, which is our next question, and what strategies can asset managers employ to achieve both financial returns and positive social and environmental impact, while also addressing the challenges of greenwashing? There's a common sign of greenwashing. Can corporate treasurers and stakeholders effectively identify and address these practices?
Again, a long question.
Yes.
To keep the auditors awake. So I'll try to make a short answer shared with Maria. Yes, of course. I think Maria mentioned this as well, and this is how as well she interacts, and her law firm is interacting with clients. Today, we were saying we are living in a very complex world, even more complex when it comes to investment. You need to be careful. We need to be careful as well as an investor. We don't want as well to invest in things that don't keep their promise, as you don't want as well to invest in funds that don't keep their promise. So we're on the same line. On top of that, as issuers, again, of course, you are issuers of green bonds, on non-green bonds as well, and we buy green bonds and we buy bonds that are not green. So to make it quick, not quick, but to be plain on that answer, we need to be very careful, and when it comes to the risk of greenwashing, which is a risk that we have been taken into account already for many years. So we've got internal process, internal procedures, we've got credit risk analysts, we've got a large ESG team, we've got many professionals involved in assessing correctly the proceeds of the bond you are going to issue, and that we are going to invest in our green bonds, impact green bonds, green bonds. So it is key to be thorough, to be aware of the necessity to have a very thorough risk analysis, whichever the maturity of the bond is. We do it in our money market funds, but we do it in all our bonds funds. And to make sure I can understand as well the full set of questions, what strategies can asset manager employ to achieve both financial returns and positive socio? Voilà. So impact investing is key. It's key today. Mobilizing private investments towards impact-driven solutions and actors is key. We need to accelerate on that. As a large investor, we've been doing this for many years. It's totally embedded, just to speak about the company I'm working for, in our ambitions, in our ambition plans for 2025. The objective is to reach 20 billion assets invested in impact funds. So this is part of our ESG ambition. So I think more than sentences, this is about numbers. So the ambition for 2025, when we started this ESG ambition plan, was 20 billion euro. So far, and official numbers, end of 2023, we already reached 13 billion, just in impact funds. I'm not even mentioning the other sustainable investing we are doing.
Maria Nefeli, your answer.
I mean, it's fantastic to hear all that Amundi is doing, but I think there are a number of players in the industry that aren't quite at the same standards. So we do see greenwashing. To be fair, though, to the industry and in the industry's defense, it has been a moving target, because what is greenwashing today was perhaps not considered so a few years ago, as all of our collective education on ESG is progressing. Two useful strategies for asset managers to get the right balance between returns and ESG, from my perspective, just drilling into some of the examples that Sandrine mentioned. The first one is in-depth due diligence, which covers all sustainability-related factors. We are increasingly seeing clients, as part of the due diligence projects, to ask for specific ESG due diligence. Look at licenses, look at potential legislation, look at potential permits. The second one is link financial terms to ESG performance going forward, to ensure that ESG becomes a responsibility for the asset manager, who in turn passes it on to the portfolio companies. And just kind of a last point about how stakeholders can identify these practices. I would say that the Sustainable Finance Disclosure Regulation, whatever kind of good or bad things people may say about it, it has created a requirement for asset managers to categorize their funds as Article 6, Article 8, Article 9, brown, light green, dark green. So we see with a lot of funds, there are pages and pages talking about green and sustainability, and then when you get to the end, they fall short of SFDR. So for me, that is a quick and easy test that stakeholders can use when they're looking to invest. How SFDR compliant is the fund? Look at the small print.
Now back to you for our next question, and the importance to consider how evolving regulation are shaping investment practices. So the question is, how do evolving environmental laws influence the structure and terms of green investment contracts, particularly in project finance and infrastructure? And what role do green bonds play in financing these contracts? So
Greece has been booming over the last couple of years in a number of respects. Two of those are the renewable energy sector and the real estate sector, which are cornerstones of project finance and infrastructure. One of the issues with this area is that ESG in project finance and infrastructure consists of a patchwork of so many different laws. So we've got domestic land laws regulating, for example, whether you can build wind turbines in a specific area. You've got other regulations controlling how noisy your data center can be. You have guidance issued by the Regulatory Authority for Waste, Energy and Water, Energy Efficiency Directive of 2023, Energy Performance of Buildings Directive of 2024, which affects the transferability of certain real estate assets. Regulation on waste disposal, how you recycle any big materials used in project finance and infrastructure projects. And in addition to this, anything relating to the shipping sector or the maritime sector is now also recently subject to this ESG regulation because of carbon emissions restrictions. So in this context, green terms in contracts are extensive. We see extensive representations and warranties. We see clients pushing a lot for third-party verification. And we also see clients proactively coming to us and saying, we're not sure we have a project finance deal yet, but we see one potentially down the line. So please, can you help us navigate all of this patchwork? Now, green bonds do not play a big role in the really kind of flagship infrastructure project finance deals we have seen lately. We worked on the sale of Terna Energy to Masdar, the Qatari-backed fund. This was a huge project. It had a lot of green investment contract terms, but not backed by green bonds. Green bonds are currently issued by a number of the big corporates, Metzlen, Piraeus Bank, Lambda, Terna, and these standards focus on the International Capital Markets Association standards. So the panel previously mentioned the EU Green Bond Standard, which is the standard we aim to aspire to from January 2025. Currently, we're not quite there yet. We're short of that. We're at a system where the proceeds of green bonds should be used towards sustainable investments in using the definition of each issuer's view of sustainability, which can be a fair bit lower than the UGB standard.
So, how legal frameworks support the enforcement of corporate ESG commitments, and what are the potential penalties for non-compliance, especially if we're talking about in anti-ESG agendas?
Anti-ESG, I mean, I saw a question about ESG fatigue, but there is ESG fatigue, but I'm not sure there is as much anti-ESG in Greece, because Greece hasn't really felt the full force of the ESG agenda. It came out of the crisis, so it's learning to adapt to that. Legal frameworks can support enforcement, first of all, by introducing penalties. Nobody likes it, but penalties manage to keep the industry in check. Secondly, providing incentives for good compliance. And thirdly, introducing stricter governance targets within firms, what we were talking about before. So passing on the obligation to the firm to pass it in turn to the portfolio company. ESG laws are relatively new, so there is not much in terms of case law or history, but what we're seeing is administrative fines, administrative monetary fines. Unfortunately, these, and perhaps it's the cynic in me speaking, but we often see asset managers just factoring that into their budgeting. Okay, let's factor X amount for potential fines, and it isn't as much of a deterrent. What really is a deterrent in this world of information and constant access to information is a public announcement, which is quite effective. And then, of course, you can't deny the possibility of actions for fraud or negligence in cases where there is misadvertising or misrepresentation. In an extreme scenario, you could even have potential criminal liability attaching to violations of specific environmental laws or specific human rights violations.
Thank you. And I'm coming back to you, Sandrine, for a finalization. And can we have, Iliana, can we have the presentation of Amundi?
Good. Interesting.
Do you have
You're waiting for the presentation.
It's a presentation. I cannot.
I hope no one is going to starve, because it's a
Oh,
lunch break.
No, thank you, thank you.
All right.
Sandrine.
I'll keep it short because I know we're all starving, unless you already had your lunch. Us not. So just we've been speaking about all these issues. Yes, it's clear. No, it's not clear. And I agree. There is a huge debate versus what should we believe. And you all need to be careful. We need to be careful. Everyone needs to be careful and go through a thorough process. So I just wanted to showcase maybe the other page to you. This is a fact that, of course, you have actors that are responsible investors. This is what we stand for. And we mentioned this both. It's a funding pillar of Amundi since its creation. And of course, you've got people trying to be more responsible. I would not say that are lying or not or pretending to be. I think we need to leave their chance to all the actors. It's a timing question for many. Even for you as corporate treasurers, you've got a different timing. You've got net zero ambition with some specific calendar depending on your industry. So I just wanted to show this in a few facts and number how we are responsible. We launched in 1988 our first ethical fund. Then, of course, I will not go through all these milestones. We developed at the origin of the low carbon indices in the ETF space with MSCI. We launched the first low carbon ETF. It was in 2014. We launched as well with large organizations such as the IFC, the first green bond. In the emerging space, of course, because what is key is to help as well the developed country, or developing country anyway, to accelerate this green bond phase. We launched our first ESG action plan in 2018, the second one in 2022. We joined the coalition. We are part of the Net Zero Asset Managers Initiative. In that space, we do talk a lot with many corporates, clients, and many investors at large, because, as I was saying, the world is complex. We all need help. And we are happy to provide as much help as possible to you on your net zero journey as well, which is strategic and important. And last but not least, we are quite a big company. We do manage over 2 trillion assets under management. Nearly half of it is responsible investing or responsible investingly managed. So I think it was important to share this again. All the opinions can vary. At Amundi, we share facts, figures, initiatives, and of course, a very, very close dialogue with the issuers you are and with the investors you are as well. So I'll stop here.
I want to thank you all. I hope this panel was insightful. From my end, it was very, and hopefully I would like to have some questions, but due to lack of timing, and time planner will kill me if I do that. So thank you all, and let's go.